Thanks for joining this Informe webinar about cash flow. I'm Tamsyn Jefferson-Harvey. I've been running my accounting practice, Seed Accounting Solutions, for just under 7 years, and I specialise in small business growth. Today, we're going to be looking at the simplest thing that you can do to improve your cash flow. This is a taster of what you'll learn in the AAT Business Finance Basics e-learning courses, but more on that later. So today, we're going to look at, firstly, the importance of having a healthy cash flow. Then we'll be looking at the simplest thing. Then we'll go through some of the examples of what can happen with your cash flow. And then finally, we'll summarise the key takeaways and look at other resources that you can use to help manage your cash flow in your business. So first of all, the importance of a healthy cash flow. As many of you will have heard the saying, cash is king, but cash really is the true reality of your business success. Cash takes all of income and all of the expenditure in your business into account. It enables you to pay bills and liabilities when they become due and keep all of your suppliers happy. It also ensures that your customers are paying you on time. And it also enables you to have enough cash to cover unexpected or unforeseen costs. And ultimately, having enough cash also makes sure that you, as a business owner, can take money out of the business and actually pay yourself. So what is the simplest thing to improve your cash flow? Forecast it. The benefits of forecasting your cash flow enable you to anticipate shortfalls ahead of time, giving you time to prepare and feel like you are staying in control and on top of money in your business. You may also identify some opportunities when to take on a new member of staff or take on a new premises. It might even be just when you want to buy your new laptop or some equipment for your business. It's also a good opportunity to check that your budget is realistic and accurate. A cash flow forecast also allows you to check that your projected profit is enough to cover all non-profit and loss outgoings, such as loan repayments, tax liabilities, credit card repayments, and also your asset purchases. So let's look at some examples. First of all, we're going to look at running out of cash, even when your sales are good. This is a really common mistake that people make. You think that the sales are going well, and suddenly you've got a tax bill that you can't afford. And secondly, we'll then look at how a forecast can really help you get ahead of problems, identifying them in advance, and the action that you might want to take to remedy them. So this cash flow statement is a template that I've downloaded from the Informe website, and I've populated it with some demo data. As you can see, the very basics of it, we have an opening balance, which would be the start of your cash position at the beginning of your financial year, and then the 12 months of your financial year after that. On this example, we've got January to December. However, if your financial year runs a different period, then you will need to change those. We have your cash on hand at the beginning of the month, and then we have your cash receipts, which then are summarised here in this as the amount added on. So as you can see, you start off with 9,687. And these are the figures here. So you start off in January with £2,539. You then receive £4,600 worth of sales, which bumps up your cash balance to 7,139. Now, underneath, we have all of the cash paid out. The spreadsheet itself didn't include tax, so I've added this in as a figure underneath. But you've got all of your expected expenses. Now, whereas with a budget, you would show certain expenses spread out over a period of over the period of the year. So, for example, an insurance premium, you may well pay £200 for the year, but actually it relates to individual months. So in the budget, you would show it on a monthly basis, but in your cash flow, you're actually going to show the month in which it was incurred because you want an accurate cash flow position. As you can see here, I forecast rent based on 2 6-monthly payments. I've got VAT payments here, quarterly ones, plus a corporation tax amount of £3,200 in this example. I've also forecast owner's withdrawals. And at the end, you've got your cash paid out and the closing position. So first of all, running out of cash when sales are good. You might be logging decent sales in your business, and your P&L, your profit and loss, is showing a healthy profit. But is that profit enough to cover your liabilities? Do you have the funds to purchase the necessary equipment in your business? Have you collected all monies owed to you from the invoices that you've sent out to your customers? Poor credit control is one of the key factors of having poor cash flow in your business. So let's just look at our spreadsheet template that we have, and we can look at some of the things and how this actually looks like in real life. In this example, you can see that whilst our sales were potentially good, and we may well have invoiced out £65,000 worth of sales over the course of a year, in this forecast, what's actually shown is that the sales are not all they've been made out to be. So we start off in January, February, and March receiving all the money on time that we've invoiced out. In April, May, and June, something's happened. The cash receipts have dipped. Now, this may well be because customers aren't paying you on time, or it may be that your invoicing has been delayed. And in fact, you're going to bill in arrears in September. There's different reasons that would show this. However, running out of cash when your P&L looks healthy is generally because your customers aren't paying you on time. So, for example, you may well have invoiced out £6,000 worth of sales in April, but only £1,200 have been received. And if your credit control processes aren't up to scratch, you're going to find yourself in a situation where you can't afford to pay your liabilities and your expenses, and you end up in a negative cash position. And actually, as you can see in this business, it's not actually making enough profit to cover the expenses in the business. This has put it in a significant cash flow hole at the end of the financial year, and is going to be needing some remedial efforts to get it out. We'll look at that in the next slide and what we can do to figure that out. Our second example is how you can use your forecast to actually get ahead of problems. Using your forecast, you can tweak figures to see what needs to be done to improve your situation. Could you potentially consider invoicing in installments and bring cash in a bit quicker? Could you invoice in advance rather than in arrears to enable you to cover the expenses that are incurred in the course of delivering your service or providing your product? Are your customers paying you on time? Can you negotiate better payment plans on your tax liabilities? Can you get better prices on your utilities, your direct costs, any costs in your business? Can you negotiate with your suppliers and see if you can get better deals? Are your employees and subcontracted workers actually working efficiently? Knowing the sales to wages ratio is a really good KPI to monitor if you have poor cash flow, to make sure that your team are fully utilised and working efficiently. Do you need to increase your sales? What do you need to increase them by? All of these things we can look at in a cash flow forecast. So let's hop over to our cash flow forecast template and look at different things that we can do to improve our cash flow. So in this example, now that we know that we've got negative cash flow, we can actually use this forecast to see what needs to be done and what changes can happen if we implement those changes. To start with, we might look at actually cashing in a little bit sooner. So rather than it being spread out and receiving more money towards the end of the year, you may well want to see if you can try and collect some of that cash from your invoices a little sooner. So if we change this to 4,500, as you can see, just having 2 extra months of keeping on top of your credit control can have a really strong impact on the next couple of months. Now, obviously, we've increased this, so we now need to decrease these figures down to a more suitable level. So I'm going to just put 5,000 there, 5,000 there. But as you can see, that has left us in a stronger position just by collecting money sooner. You may also want to look at some of the other things. For example, here, we've got our quarterly VAT payments. If you're really struggling, you can always try and get a payment plan with HMRC and try and spread out some of those payments over 3 months. Your corporation tax, you may wish to also spread out over a period of months. However, obviously, planning for your corporation tax bill ahead of time is going to put you in a stronger position rather than having to implement a payment plan. You may wish to also see if you can spread your rent out over a period of months rather than biannually. this can obviously help improve your cash flow. Again, with your purchases, you may want to try and ensure that you have a consistent outgoing. Many things nowadays you're able to pay in smaller chunks over a period of time rather than accruing larger costs. And actually your suppliers may well prefer having smaller installments paid in advance. If you know, for example, that you're going to have a cash flow dip, for example, here, we can see that we're still in negative cash flow in these last few months. We may need to look at actually increasing sales. So actually, what do we need to do to increase sales? Well, again, here we've got one quite low month. So what can we do to drive those sales forward? How can we make more sales? Do we need to make more sales? Do we need to increase the prices? Do we need to increase the amount of times people are buying from us? Lots of things here that can help you drive and improve the profit position of your business and thus your cash flow position. So if you know ahead of time that you're not going to have enough money at the end of, what month is this? July. Then you might want to look in June about driving those sales or reducing your costs. Or it may be that you in fact take out a loan or search out some equity investment from an investor. So let's say in this example that we take out a loan of £5,000. Oh, 5,000. Well, now that we know that we've got a loan in the business, we know that for the rest of the financial year, we're actually going to be in a cash flow positive position. Obviously, now that we've got our loan, we now need to forecast those repayments. So that will then also need to be brought into the cash flow statement. So as you can see, by having a forecast, there's lots of different things that you can do to see what you can do to improve your cash flow position and the impact that those changes will have. Again, really important to make sure that you've got clean and up-to-date data so that you can update this effectively. A lot of the softwares that I will discuss later on sync in with your accounting software in real time, so you'll get an accurate cash flow forecast position. However, if you're using a spreadsheet, it's important that you update it on a regular basis and you have accurate data to plug into it. And here I've got a quote by Richard Branson: "Never take your eyes off the cash flow because it's the lifeblood of business." It's so important to maintain a healthy cash flow in your business. Without a healthy cash flow, your business will likely fail, and probably quite quickly. So the key takeaways from this webinar today: why should you forecast cash flow? Forecasting cash flow enables you to make sure you have enough cash to cover your drawings and liabilities. It enables you to sense check your sales levels and margins. It can help you make data-driven decisions so you know when to take on a new member of staff or premises. It really helps you stay in control. Running a business is an extremely stressful circumstance to find yourself in at times, and enabling you to stay in control can really help make that a little bit easier on the entrepreneurial roller coaster. And finally, you can be prepared for any eventuality and know ahead of time what can be done to improve it and hopefully avoid having cash flow dip. Finally, some other resources that you might want to look at to help you manage and improve your cash flow. The Inform Me website has plenty of resources and templates that you might want to look at. There's also some forecasting software out there which is targeted at business owners. You can look at Futurely, Fluidly, Float. There are others available. You may well just want to manage it in a basic spreadsheet. The AAT Business Finance Basics course is really good at giving you a great grounding on all the finance basics that you need to run your business successfully. And finally, if you've got an accountant, reach out to them if you've got any problems or concerns about your cash flow and see what you can do to help improve your situation.